Okay, let's unpack this. We are diving deep into a story that's right at the intersection of, well, future finance and ancient wealth. We're talking about Tether, the issuer of the world's largest stablecoin, USDT, and its absolutely stunning, I mean massive and really aggressive move into physical gold.
It's a huge story.
It is. I mean, when we usually talk about Tether, the conversation is all about digital dollars, transparency, or maybe their staggering position in U.S. Treasuries. But in 2025, Tether has quietly done something shocking. They are stacking bullion at the volume of a sophisticated mid-tier central bank.
The scale is monumental. Per the Q3 2025 estimates, Tether's gold holdings are starting to rival the official reserves of established nations.
Right. Countries like South Korea or Hungary. So the question really isn't if they're buying gold anymore. It's why. Why has a $174 billion crypto company decided to become a sovereign-scale gold buyer, and what does that mean for the risk you're taking when you hold their token?
And that aggressive pivot is the core mission we're tackling today. This move raises systemic issues that ripple out far beyond crypto, touching global commodity markets, traditional finance, everything. So our goal for you, the learner, is to synthesize the hard data we have. We're looking at Tether's own public attestations, analyst reports from Jefferies and Reuters, and the skeptical critiques from rating agencies like S&P Global. We want to answer one critical question. What does this institutional scale gold buying mean for the stability of the digital dollar, the gold market itself, and fundamentally, what risk are you exposed to when you use USDT?
So how are we going to structure this?
We'll break it down clearly. First, we'll cover the basics, the indispensable role USDT plays, and the shocking size of this gold stack. We've got a key analogy for the plumbing there. Second, we'll look at how Tether is becoming a gold industry player, not just a buyer. They're investing in future cash flow, not just bars of metal.
Okay, and after that?
Third, we will analyze the regulatory heat, especially that S&P downgrade, and Tether's own defense. And finally, we'll game out the massive future scenarios this whole thing unlocks for global finance.
Okay, so we all know USDT is supposed to be $1, but let's just stop and remember its foundational role in the economy. It's not just a token, it's this $174 billion circulatory system, the instant global settlement layer. It's the vital plumbing of the entire crypto ecosystem.
It really is. If you're trading crypto anywhere in the world, chances are you are using USDT to make that trade happen.
And that makes it absolutely critical. It lets billions of dollars move 247 across every time zone on dozens of blockchains instantly, without ever touching the slow, restrictive, old-school banking system.
Which concentrates the risk.
Exactly, because if that plumbing gets clogged, or if the peg breaks in a big way, the consequences are immediate and catastrophic. It would just drag down liquidity and prices everywhere.
And the stability of that one-to-one peg relies entirely on Tether's promise and, well, the market's belief in it. The whole theory is that every single USDT token is 100% backed by liquid assets held by Tether. So you, the user, can always send one USDT back and redeem it for $1.
In theory.
In theory. And that redemption mechanism relies entirely on the quality, the liquidity, and most importantly, the accessibility of those reserves.
This is where we need to be really clear about the difference between USDT and, say, a normal bank deposit.
Yeah, and this brings us to analogy one, the trust bridge. Think about a bank deposit in the U.S. It's a trust bridge built on concrete piers. It has government backing, FDIC, insurance regulatory oversight, and a central bank backstop.
The Federal Reserve?
Exactly. The Fed acting as the lender of last resort. During a bank run, the Fed can inject liquidity to stabilize everything.
Right, but USDT?
USDT is a trust bridge built over a void. It has none of that. No institutional safety net. It relies purely on Tether's own solvency, its own liquidity management. It survives or fails based on its own balance sheet, which makes what's on that balance sheet so incredibly important. Hashtag tag 1.2, the shocking scale of the gold stack.
So let's pull up the numbers. Let's see what they're actually sitting on and what they're doing with all the profit from these high interest rates. The latest Q3 2025 attestation is, frankly, staggering. They reported $181 billion in assets backing $174 billion in liabilities.
So it's a $7 billion difference. That's their equity cushion, they claim, the buffer to absorb losses.
Right. And despite this whole gold move, we have to remember the bedrock of their reserves is still U.S. government debt. Tether holds about $112 billion in U.S. Treasuries and similar short-term dollar assets. Think about that for a second.
It's an astronomical number.
That position alone makes Tether one of the largest private sector holders of U.S. government debt on the planet. They are already a deeply entrenched player in the traditional U.S. financial system.
And that income from Treasuries, that's the fuel for this whole diversification strategy. The high interest rates go straight to Tether's bottom line, giving them billions in capital to play with, and they are aggressively deploying it.
You can see it in the reserve composition.
Absolutely. Precious metals and Bitcoin together now make up about 12.5% of that massive reserve stack. If you just isolate gold, it's roughly 7% of the total balance sheet.
And that's up from basically nothing a few years ago.
A huge, huge shift.
The scale of this really hits you when you translate those billions into physical metal.
Yeah, the Jefferies analysis that Reuters covered put a real figure on it. They estimated that as of Q3 2025, Tether was holding roughly 116 metric tons of physical gold.
116 metric tons.
At the market prices then, that's a pile worth around $14 billion. It's one of the single largest commodity exposures held by a private, non-financial company anywhere.
Can you even imagine trying to store 116 tons of gold? That's not a vault. That's like a subterranean Bond villain's lair worth of bullion.
To put that in context, 116 tons makes Tether one of the largest private sector holders globally, easily rivaling the gold reserves of sovereign nations.
You mentioned Hungary.
Hungary holds about 94 tons. Greece holds about 114 tons. So yeah, we're talking about central bank scale commodity exposure, hardwired right into the core of crypto's dollar liquidity. It's the definition of systemic integration. Hashtag tag 1.3, the two buckets of Tether Gold.
Okay, now this is a crucial distinction that I think gets lost in the conversation a lot. We have two separate but related buckets of gold here, and they have very different implications for you, the user. The first one is Tether Gold, or XAUT.
Right.
XAUT is a totally separate tokenized product. It's designed so each XAUT token equals exactly 1 fine troy ounce of physical gold.
And that gold is meticulously stored in high-security third-party Swiss vaults, meeting those strict London good delivery standards.
And crucially, that gold is allocated and ring-fenced. The underlying bars are documented, traceable. It's set aside solely for XAUT holders.
And that's about 12 tons, right? Roughly 10% of their total bullion stash is dedicated just to backing XAUT.
So what about the rest?
And that's the distinction you have to grasp to understand the risk profile of USDT itself. The overwhelming majority, about 104 tons, so 90% of the entire stash, sits in the second bucket, the USDT reserve backing.
Okay.
This gold is not specifically allocated to individual USDT holders. It sits inside the general reserve pool, right alongside the treasuries, secured loans, and corporate debt.
So if you're holding USDT, you're holding digital dollars, but beneath the surface, a slice of that $174 billion is riding on the price of gold, not just U.S. interest rates.
And the appeal of XAUT itself really highlights a massive gap in traditional finance.
How so?
Well, traditional gold products are slow, they're expensive, you have to buy a lot. XAUT offers instant settlement, 247 markets, fractional ownership.
And you can self-custody your exposure to offshore gold. That's a huge draw for global wealth, especially in places with unstable currencies or capital controls.
Exactly.
Yeah.
XAUT's success, along with rivals like PXG, shows the massive growth in the real-world asset, or RWA, sector. Tokenized gold is now worth well over $4 billion. It's a proof of concept for how to digitize hard commodities at scale. So if the scale is shocking, the velocity of the buying is an absolute indicator of a sophisticated market-moving strategy. This is not passive accumulation. This is aggressive action.
How aggressive?
In the third quarter of 2025 alone, Tether bought approximately 24 tons of gold.
24 tons in 1 quarter.
To put that in perspective, that volume of purchasing was more than the acquisitions of any single sovereign central bank during that same period.
So a private company is outbuying nation states.
When that happens, you know they're serious, and you know they're influencing prices.
And the market impact was pretty clear.
Oh, immediate. That 24 tons was roughly 2% of total global gold demand for that quarter, and around 12% of all known official sector purchases.
So analysts are suggesting this surge in demand likely contributed to the gold rally we saw in 2025.
I find that compelling. It introduces a new structural element to the demand side that traditional gold models just weren't built for.
It also has to tighten the physical market, right?
Absolutely. Buying 24 tons of London good delivery, standard gold, in 1 quarter means you're absorbing a significant chunk of the available physical supply. This is a deliberate tightening of the supply chain, ensuring the reserve has robust, tangible backing.
Now, here's where we move beyond just stockpiling bars and into something much more like financial engineering. Tether isn't just buying existing gold. They're actively investing over 300 million US dollars into the actual infrastructure of the gold industry itself.
This takes us into the complex world of royalty and streaming, or RNS, but we can simplify it.
Please do.
Think of companies like Elemental Altus, Metalla, or Gold Royalty Corp. It's vital to understand they are not miners. They don't have the operational risks and high costs. They are specialized financiers.
So they provide the capital.
Exactly. They provide crucial capital upfront to mining operations, often smaller miners who can't get cheap bank financing.
And in return,
In return, the RNS company gets a reliable slice of future revenue. This comes in two forms: a royalty, which is a guaranteed percentage of the mine's future sales, or a stream, which is the right to buy the metal they produce at a steep, pre-agreed discount.
so Tether is basically buying a claim on gold that hasn't even been dug up yet.
Precisely.
That immediately changes the conversation. This brings us to analogy 2, the macro hedge fund. Tether is acting less like a static safe where assets just sit, and far more like a private sovereign wealth fund or a sophisticated macro hedge fund managing complex investments.
They're taking the enormous, predictable profit they carry from their treasury holdings and immediately recycling that income into long-dated gold-linked income streams through these RNS companies.
I have to interject here, though. Doesn't this introduce a ton of unnecessary complexity for a stablecoin reserve? It's supposed to be safe and simple. Now they're holding complex derivatives based on future mine production.
That's the tension S&P focuses on. But Tether's defense is that this income is highly resilient. If gold prices rise, the revenue from these royalties and streams rises with it. It gives them inflation protection and a geopolitical hedge that's totally independent of the US dollar or the US banking system.
So they're prioritizing global resilience over the simple safety U.S. regulators would prefer.
That's the argument. And that flagship investment, the $200 million into Elemental Altus, secured them a 37% stake and a board seat. This is not passive.
So they have direct input into dozens of future gold and metal projects.
Yes. It doesn't just promise income. It helps them lock in future bullion supply for both XAUT and the growing USDT reserves. It is strategic positioning in the commodity supply chain. Hashtag 2.3, building a Wall Street caliber team.
And the final piece of evidence that this is a long-term institutional strategy is the talent they're hiring. They brought on 2 senior bullion specialists, Vincent Domian and Matthew O'Neill, both from HSBC, a major global commodities bank, to run Tether's in-house metals desk.
That appointment is profound. That's the kind of team you'd expect to see at a top-tier investment bank or a central bank, not a stablecoin issuer.
Right. It signals a deliberate, sophisticated, and active management strategy. They aren't just calling a dealer and buying bars every quarter.
This team will be managing trading strategies, hedging exposure, financing these deals, actively managing their entire gold portfolio. This move confirms Tether is serious about turning its profits into hard assets that are intentionally placed further outside the direct regulatory reach of the U.S. financial system. They're building the human capital to run a global asset manager that operates commodities on a central bank scale.
So Tether's big defense is diversification. The CEO, Arduino, argues gold is a long-term risk reducer, a hedge against instability and fiat debasement. But this forces us to address our first crucial knowledge gap about how this all works in a real crisis. If Tether is holding gold to diversify away from US dollar risk, how effective is that gold really if the crypto ecosystem itself has a sharp, sudden crisis and forces them to sell everything?
That's the classic catch-22, isn't it? The moment of maximum stress on USDT will correlate strongly with a panic across all crypto assets, including Bitcoin, which is also a material part of their reserves.
So does the hedge actually work when they need it most?
Well, that's the question for you, the listener. In a massive crypto market collapse, if redemptions surge, Tether would be forced to sell assets to defend the peg. They'd liquidate treasuries first, sure. But if the redemption wave is big enough, they'd have to move on to the volatile assets, the Bitcoin and the gold.
And if they have to sell 116 tons of physical gold quickly in a crisis?
That forced liquidation would put downward pressure on the gold price itself. If gold's value drops at the same time as crypto because Tether's a forced seller, the gold doesn't function as a hedge at all.
It just amplifies the market stress. It reduces the value of their reserve cushion right when they need it most. So this leads directly to our first knowledge gap question. Tether argues gold is a long-term risk reducer. But if the crypto market crashes and forces Tether to sell, will gold act as a reliable hedge by retaining its value, or will Tether's forced high-volume liquidations simply amplify the market stress by pushing down the global price of the commodity?
And the answer to that really dictates whether that $14 billion stack is a safety net or a stress multiplier. This aggressive, actively managed strategy brings us right back to the fundamental issue of transparency and reporting. Tether uses quarterly attestations from firms like BDO Italia, but critics, they demand a full audit. We should probably define the difference.
Yeah, that's important. An attestation is what?
An attestation is very narrow. It's basically a snapshot confirming that on one specific day, say, the last day of the quarter, Tether's assets were greater than its liabilities. It's like a single photograph.
Whereas a full audit.
A full audit is a deep, continuous investigation. It requires forensic testing of the entire quarter's transactions, verifying the custodians, who actually holds the gold and treasuries,
Yeah.
and detailed breakdowns of their investments. It's comprehensive oversight.
And critics, especially like S&P, focus entirely on what the attestation doesn't show. We don't get clear public rules for which money market funds they use, which specific custodians are holding the gold bars, or what their plan is for rapid asset sales. It leaves huge operational questions unanswered.
And we can't discuss this without acknowledging the history here.
The regulatory history, right?
Tether has a substantial rap sheet. The firm paid tens of millions to settle probes by the New York Attorney General and the CFTC over past misstatements about being fully backed and for commingling funds.
So that history of, let's call it a lack of disclosure, is why a simple attestation isn't enough to calm the institutional market. They need a full audit to establish real trust. Hashtag 3.2, the S&P downgrade in reserve quality. And the most direct critique of this gold strategy came from the traditional finance world. S&P Global, the rating agency, issued a major downgrade of USDT's stability score.
A big one. They cut it from constrained, a 4 out of 5, down to weak, which is a 5, the lowest possible rating.
And why? What was the reason?
It's rooted entirely in this aggressive pursuit of yield and diversification, specifically their growing reliance on what S&P calls higher-risk assets.
So they lump gold into that category.
They do. They lump Bitcoin, physical gold, corporate bonds, and secured loans into this higher-risk bucket. And the segment has grown from 17% of total reserves a year ago to about 24% now. S&P sees this as fundamentally eroding the safety of the token.
But wait, why would S&P treat gold, the classic safe haven, as a high-risk asset for a stablecoin? That seems counterintuitive.
It comes down to two things: pricing and settlement risk. Gold, while stable over decades, is volatile over short periods. Tether can't guarantee the exact price they'd get if they were forced to sell.
Okay, and settlement.
More importantly, settling 116 tons of physical gold means moving physical metal and doing complex custody transfers. In a panic, a bank run on USDT S&P is skeptical that Tether could liquidate $14 billion of gold fast enough and at a reliable price without massive market disruption.
So they might fail to meet redemption needs.
That's the fear.
And S&P's risk model actually quantifies this. They look at the combined exposure to Bitcoin, which is about 5.6% of reserves, and gold at 7%, plus the other illiquid assets.
And a sharp, sustained drop in those assets, maybe triggered by a crypto crash, could theoretically wipe out Tether's entire $6 billion equity cushion.
And if that cushion is gone and redemptions keep coming,
The stablecoin becomes underbacked, the peg breaks, and that triggers the exact systemic stress that Tether is supposed to prevent.
so that's the heart of the critique. Tether's search for high yield and diversification introduces volatility and complexity that compromises the essential, boring job of being a stable dollar token. Hashtag 3.3, the regulatory fork, the Genius Act.
Regulators, especially in the U.S., have definitely taken note of this reserve shift. New legislation, often called the Genius Act, aims to enforce a very strict, conservative definition of what a U.S. payment stablecoin has to look like.
And what does that look like?
It's an extremely conservative list of permitted assets for tokens targeting U.S. users. Only cash, U.S. Treasuries, central bank deposits, and very liquid, short-term money market funds.
And what's excluded?
Crucially, commodities like gold, because of the volatility and custody complexity we just talked about, are deliberately and explicitly excluded. The U.S. framework demands safety and simplicity above all else.
So this restrictive environment has forced Tether into a really interesting two-pronged approach. They're not fighting the regulation head-on, they're segmenting their market. They're launching a new U.S.-compliant stablecoin called USAT, which will strictly follow the U.S. rules and won't be gold-backed.
That one is clearly aimed at U.S. institutions who need regulatory certainty.
Right. But at the same time, and this is the aggressive controversial part, Tether is doubling down on the gold backing of the existing huge offshore issued USDT.
They're leveraging their bases outside of strict U.S. jurisdiction. El Salvador, the British Virgin Islands, Cayman Islands, which gives them the legal flexibility to keep increasing their bullion exposure in the main token's reserve.
But this creates a huge structural problem for the market.
It really does. You now have two distinct products from the same company. One is a small, regulated, simple token, USDT, for U.S. institutions, and the other is the gigantic legacy token, USDT, with this spicy, aggressively managed mix of assets tailored for the global crypto-native market.
So for the average user, the legal and financial rules for their digital dollar now completely depend on which token they happen to be holding.
Which just adds a massive layer of complexity and opacity to the ecosystem. Hashtag tag 3.4 Tether strategic defense. Now, to be fair, we have to explore Tether's defense because they firmly believe their strategy isn't just safe, it's actually superior to the traditional model. The CEO, Paulo Ardoino, argues that mixing U.S. Treasuries with BTC and gold actually reduces long-term systemic risk.
How does he figure that?
The core argument is about diversification away from a single currency, a single sovereign risk, or a single banking system. They see the gold and Bitcoin as a necessary hedge against global currency debasement and geopolitical risk.
So they're positioning USDT not just as a stable dollar, but as a universally resilient store of value.
Exactly. Something that can maintain its purchasing power even if the traditional U.S. financial system hits a crisis.
And that confidence is backed by just overwhelming profitability, which is a game changer for risk management.
It really is.
Tether's business model, that treasury carry trade, means they generate enormous low-risk profits. Reports showed they pulled in, $10 billion in profit for the first 3 quarters of 2025 alone.
An incredible number. And that financial muscle means they can absorb high volatility in their risk assets without ever touching the statutory reserves needed to defend the peg. This immense continuous profit is why critics often call Tether a money printing machine.
It's a fascinating comparison they make to traditional finance.
What's fascinating here is that comparison. Traditional fractional reserve banks operate with minimal required reserves because they rely on the central bank as a backstop.
A luxury Tether does not have.
Right. So Tether, lacking any central bank lifeline, argues they must keep more than 100% of their liabilities covered by assets.
And their track record, having survived multiple massive crypto bear markets purely on their own liquidity, is their greatest defense against critics.
They view their aggressive management as a feature, not a bug, ensuring the token's global resilience.
But isn't that just classic financial engineering? They're making massive risk-free profit on treasuries, and now they're using that buffer to speculate on volatile assets like gold and BTC. Why should the average USDT holder trust that, especially since the assets they're speculating with are ultimately derived from the yield on the dollar they're supposed to represent?
It's a valid skepticism. The market tolerates it because they've survived, but structurally, it means Tether is fundamentally a hybrid, part stablecoin issuer, part prop trading desk.
So the user is buying into a sophisticated financial structure, not just a simple 1.1 receipt.
And the key to trusting that structure lies in the details of how the assets are protected.
Tether tells us the gold, all 116 tons, is safely stored in high-security Swiss vaults. But as we said, the 104 tons backing USDT sits in the general reserve pool, and they only provide attestations, not full audits. The specifics on legal custody and ownership are notoriously vague.
And this vagueness gets to the core vulnerability of holding any centralized stablecoin. We know that 12 tons backing XAUT are typically ring-fenced for token holders. But the 104 tons backing the general USDT reserve are considered a corporate asset.
So if Tether, the corporate entity registered in places like the BVI or Cayman Islands, were to face a massive fine or insolvency or regulatory seizure, where do those gold bars legally sit?
Are those 104 tons truly protected by a legal trust that allocates them specifically to the benefit of USDT holders as collateral? Or are they just corporate assets that could be seized by a creditor or commingled with the firm's other investments if a catastrophe hits?
And the lack of a full audit means we don't have the legal documents to answer that with certainty.
We don't.
This leads us to our second key knowledge gap question for you to consider, because it determines whether the gold is robust collateral for you, the token holder. Given that Tether relies on attestations, not audits, What are the specific legal protections or ring fencing measures that prevent the 104 metric tons of physical gold reserves from being seized or commingled with general corporate assets during a corporate solvency crisis or a major regulatory enforcement action?
Until that is fully audited and disclosed, the risk remains that the gold is just a profitable asset for Tether, not secure collateral for the user. The primary future implication here is the permanent structural change Tether is introducing to the traditional gold market. Historically, gold is driven by things like central bank policies, jewelry demand, macro sentiment. It's a slow-moving geopolitical asset,
But Tether introduces a new dynamic,
a perpetual one. Their massive profits from the Treasury carry trade mean they have a constant structural need to deploy capital, and they've chosen gold as a primary destination.
which translates to a steady drip of demand.
That could fundamentally support gold prices for years, especially if USDT keeps growing. They're a structurally long, crypto-funded buyer.
But this cuts both ways. It creates a profound risk inversion that I don't think people are scrutinizing enough.
Mm-hmm.
Gold is the ultimate safe haven, historically protecting investors from speculative excess. But now, because one of its largest marginal buyers is Tether, a company tied directly to the high-risk crypto ecosystem, gold's price could get tangled up with crypto volatility.
A very real risk. Think about that moment of maximum stress we talked about.
Scenario C. If Tether is forced to dump metal quickly, say $5 billion worth in a week to defend the peg, gold would suddenly be trading on crypto headlines, on fear and redemption pressure, not just inflation or interest rates.
It becomes an amplifier of crypto stress, rather than a reliable hedge against it. That concentration risk in a lightly regulated entity is a major concern for the entire commodity sector. Hashtag 4.2, the fork in the stablecoin road.
And Tether's dual strategy, the regulated USAT versus the aggressive gold-backed USDT, it reinforces that the stablecoin market is splitting into two distinct paths. It's forcing users to make a choice about their risk preference.
Absolutely.
On one path, you have the regulation-friendly coins. These are tokens like USDC and the new USAT, backed by ultra-safe U.S. Treasuries, subject to stringent rules, designed to be like audited cash equivalents.
That path is all about safety, liquidity, and domestic compliance.
And the other road.
The other road is the crypto-native hard asset-backed avenue. This is where the legacy USDT is aggressively positioning itself, leaning into gold and Bitcoin, leveraging its offshore base.
The narrative there is all about resilience. They're protecting users not just from U.S. banking risk, but from long-term fiat currency debasement.
They're building a globally accessible, resilient reserve model designed for high growth and high yield, consciously accepting higher volatility risk.
And beyond the stablecoin structure, Tether's success with XAUT has huge implications for the whole real-world asset, or RWA, sector.
It really does. XAUT's market cap is in the billions and has grown so fast, which just confirms the demand for tokenized commodities is huge.
So it proves you can run a multi-billion-dollar commodity token on-chain and plug it into global DeFi and CeFi.
And that strengthens the broader case for tokenizing everything else. Real estate, corporate debt, using the same concept of instant, transparent, 24/7 settlement, hashtag 4.3 future scenarios, host and expert collaboration.
Okay, let's clearly define the three most likely paths this story could take, based on all this conflicting data.
Let's start with scenario A, the shadow central bank. This is the optimistic path for Tether. They continue to manage the complex risk profile successfully, the gold and Bitcoin bets pay off, and they grow their equity cushion. Global regulators, unable to stop its utility, eventually just tolerate its role.
So USDT remains dominant, acting as this accepted, if very unusual, piece of the global financial architecture, a private institution issuing quasi-money.
In that world, their global influence expands. They become a price setter in certain commodity sectors, further blurring the line between a private company and a sovereign entity.
Okay, what's the middle ground?
Scenario B, slow pressure and change. In this future, regulatory pressure from the EU, the US, it grows intense. Conservative, regulated competitors like USDC gain significant market share in Western markets. The rating agencies keep Tether at a low grade, which limits its uptake by banks.
So Tether might respond by shifting its reserves back toward ultra-safe assets, just to reduce the regulatory heat.
Exactly. USDT remains highly relevant in emerging markets, but it loses the battle for institutional trust in established financial hubs.
And finally, the scenario that keeps regulators up at night.
Scenario C, sudden stress event. This involves a catastrophic combination shock, a sharp, sudden fall in both gold and crypto prices at the same time, maybe combined with a legal shock that triggers mass panic.
Massive, high-speed redemptions overwhelm their liquidity.
Tether is forced to sell massive amounts of treasuries and then move into its gold and BTC holdings. This forced selling puts severe pressure on the USDT peg, hurts gold prices globally, and spreads system-wide stress across the entire crypto ecosystem.
Proving the S&P critics right, this is the ultimate test of that trust bridge over a void. If the $6 billion equity cushion vanishes because the risky assets tank, Tether has to find liquidity fast, or the entire crypto plumbing system just seizes up. The U.S. is trying to define compliance and force Tether's new product, USAT, into a safe box. But Tether is a global behemoth focused heavily on offshore and emerging markets, using its El Salvador base as a regulatory shield.
The effectiveness of that offshore strategy is the key geopolitical unknown. If Tether keeps growing its gold backing, it deliberately steps outside the model preferred by powerful global regulators like the Financial Stability Board or the IMF. These bodies dictate global financial conduct, not just U.S. rules.
So compliance in one country means little if the big liquidity providers elsewhere close the door.
Precisely. Take the European Union's MiCA regulation. It sets detailed rules for stablecoins in the EU. If a global body decides that tokens with complex, non-audited commodity-backed reserves are too risky, they won't chase Tether in El Salvador. They'll target decentralized crypto exchanges like Binance or Coinbase, forcing them to delist any token that doesn't adhere to specific reserve composition rules.
Which leads us to our final high-level knowledge gap question for you. Will Tether's expansion into El Salvador-based offshore assets be sufficient protection against global regulatory actions? Or will powerful jurisdictions outside the U.S., like the EU, eventually use their influence to force major crypto exchanges to delist stablecoins that do not adhere to specific conservative reserve composition rules, effectively cutting off USDT's access to the major global liquidity hubs? #OutETRO. Okay, let's bring this complex analysis back down to a singular, actionable takeaway for you, the learner. The key is recognizing that when you hold USDT, you are holding a far more complex financial instrument than just a dollar receipt. Your digital dollar is now indirectly riding on the price of 116 tons of physical gold and a massive Bitcoin stack, as well as U.S. Treasuries.
It's an actively managed hybrid risk portfolio. It's closer in structure to a sophisticated macro hedge fund than a simple safe bank account.
And that leads to the final practical advice.
Yes, USDT's long track record of resilience is impressive. But given the complexity, the regulatory heat, and the concentration risk, we cannot advise holding it as your primary long-term savings vehicle. Use it as a highly liquid tool for rapid trading and transfers. And crucially, diversify your digital dollar exposure across multiple issuers, USDC, USAT, others, to mitigate the risk of having so much of the global crypto market tied to one single opaque balance sheet.
And here is a final provocative thought for you to mull over as we close out this deep dive, something that really cuts to the core of this whole story. Tether is earning billions in profits from high-yield U.S. Treasuries, the safest asset on Earth, the foundation of the global financial system. It is then immediately taking those massive dollar profits and actively rotating them into offshore physical gold and Bitcoin.
So,
if the largest dollar stablecoin issuer is consciously using its U.S. dollar profits to hedge aggressively against the dollar and the very U.S. financial system that generates its wealth, what does that tell you about the future confidence in traditional fiat currency?
that's the question to sit with.
Thank you for joining us on this deep dive into the 116-ton gold stack. Keep exploring the interconnected, constantly evolving world where crypto meets traditional assets. We'll see you next time.